Thought you were gonna begin, John.
Here we go, Zach. Let's go. What's up, everybody? I'm John Sidoti. I'm your host tonight with our guest, Zachary Zakas. Zakas, right? Zakas?
Yeah, you
Zak
got it.
Zakas. Zak Zakas, a leasing agent with Colliers International. Um, Zach is operating in the Savannah market, one of the hottest industrial markets globally, right? You're a global broker, right, Zach?
I guess you
Um,
could say that. Yeah, yeah.
you can definitely say that. You're international, right? And unfortunately, Andy is sick with COVID, so he is unable to join us. Hopefully, he feels better. But let's go with this, Zach. All right.
Hey everyone, just want to say thanks for having me. Thank you, John. I hope it doesn't come out too much, but you might notice that I have a bit of a Boston accent, much like John. But as he's told you all, I am currently based in Savannah, Georgia. I would consider myself a industrial real estate broker by trade. I think this presentation is mostly geared to flex industrial, which we'll get into in a little bit. But as far as me, I do it. John also likes to refer to me as a leasing broker, which I do a lot. But I'll have you all know that I also do many sales, both representing either landlords or users or purchasers. Actually, just was involved in a transaction with John here in Savannah on an awesome property. But I would say that I'm majorly focused on leasing. I do all kinds of different stuff from truck terminals to large, what you call it, like a big box distribution warehouse, all the way up to 1 million square feet in one building, all the way down to smaller multi-tenant properties like John invests in, as small as say 5 to 10,000 square feet. The Savannah market specifically, which this presentation isn't going to be about, has been rapidly expanding due to our port. We're what most investors would consider a tier 3 city or tertiary city in terms of the real estate market. But the industrial market in Savannah can compete, with Long Beach, with New Jersey, with Chicago. So it's been exciting. There's been a lot of stuff going on here. Hyundai recently came in and built what they're calling the meta plant. But we're seeing all of that here trickle down into these smaller properties that aren't necessarily geared towards these, super large companies, but that we have found and many other investors have found to be very profitable. And so that's what we're really more going to be focused on tonight. Um, John, I don't know if you have anything else to say, but I think we could probably move forward.
Yeah, I think this industrial market is great, especially coming off COVID. We are going into a great time to be an industrial real estate investor. Um, and we're gonna learn a lot from this presentation, and we're gonna see a lot of it applied over the next couple of years. So um, let's go.
Awesome.
So
So I'll start with a broader overview. So just why industrial? There's a very limited supply of industrial zone property. Most municipalities, cities, they're very reluctant to, say, rezone a property from, say, residential or agriculture into an industrial zoned area, where they're much more likely to rezone something into a multifamily classification or single family residential, or even commercial or office more so than industrial, just because it's there's a lot of environmental stuff that is usually related to industrial uses. It often doesn't bring in as much tax dollars to the cities. So cities are just very slow to rezone. I don't know if I'd say reluctant, but it's not often the easiest thing to do. So on the flip side, that also prevents a lot of barriers to entry for competition. Sort of like what's out there now is what exists, and there's not a lot of projection to bring a ton more onto the market, just because it's very difficult, it's costly, and it's very timely to do so.
That's awesome, Zach. Um, and I don't know, like you were saying, I think that that makes these assets in this land that much more valuable, right?
Yeah, I mean that, scarcity is going to drive up the value of the property for sure.
Awesome.
Um, because of this, I think there's a lot more stability in this asset class versus, you know, other commercial product types. Some others you might see a year over year, you might see a higher return one year versus the other versus industrial, which has seen much more stable. It's sort of easier to track, I would say. Um, I think overall it's a less risky investment. I think a lot a lot of eyes begin to view this asset class as a good investment during COVID, because when we kept hearing that term like essential workers, essential jobs, essential industries, well, a lot of that had to do with the industrial type work. So a lot of these buildings started trading much more so than they had years prior. I think it really showed that these were, I think, what John refers to as a resilient asset class.
Yeah, and I think one thing that I really like about this, the obviously the stability, that is one thing that comes to mind, but I also think the predictability, right? And when you and I guess we'll go into it later on in the presentation, but the predictability in rents, longer term leases, you can bake in those automatic annual increases in the rent, which obviously that adds to the value of both the property and just the whole concept of industrial real estate, right, Zach?
Yeah, I think one other aspect of the stability side of things is often when you're handling an industrial lease, if you're an industrial landlord, if a tenant is turning over the building and you're trying to lease it up again, it's often going to be a similar type of tenant, or it's going to require very little enhancements to the property or changes. With other asset classes, if you're in retail or office, you're going to put that space up for lease. A new tenant is going to come in. They might have a completely different configuration or business model or brand that requires the landlord typically to invest capital back into the property to resuit it for that tenant. So I think a lot of people don't realize that, but when you're the landlord and you're leasing a commercial property, you're typically putting your own money into the building every time you have to what we'd call re-tenant the property. So if you're currently leasing to Best Buy and they're gone and you have to find a new tenant, and Target's going to come in or something, the landlord's going to be the one uh, paying for most of the improvements to the property, to the reconfiguration, and typically that'd be called a tenant improvement allowance. With industrial, it's kind of like take it or leave it for the most part. Not always, but
Or fix it yourself, right?
yeah, it's
And
much simpler, a little less hands-on. I would say.
You get what you get and make the best of it. But also, yeah, I think that pretty much summarized it.
Okay, so we talked about industrial as a whole. Now, I'd like to focus a little more on what actually is flex industrial, which is kind of John's bread and butter. He loves this stuff more than anybody I know. So flex can mean a lot of things, and you'll often hear in different parts of the country, brokers or investors, they'll refer to flex as different types of buildings. So often when a person will call me and say, "Hey, I'm looking for flex," whether it's a tenant looking to lease or someone looking to buy, I'll say, "Well, what's your definition of flex?" Some people refer to it as shallow bay or small bay. In Savannah, I think would consider flex anything to be a multi-tenant with spaces that are under 10,000 square feet. So now a lot of John's investments are oftentimes even broken down smaller than that. It's kind of can be a mix between it's bigger than say self-storage, but will be a little smaller than what most people would consider shallow bay. But usually flex industrial will include some type of office space, usually quite small, with the majority of it being warehousing. We'll see a lot of stuff here in Savannah that's laboratory type work, but I've heard people refer to it as contractor storage, jumbo self storage. There's a lot of different terminologies, and
Commercial
it's not,
storage,
yeah,
industrial storage. So,
yeah, it
sorry.
it's not always the same, but there's a broad spectrum of what most would call industrial flex.
Awesome. Thanks, Zach.
And so just to kind of piggyback off of that, there's there's so many different tenants that can use a flex space, whether it's last mile distribution, contractors, like I said, labs. It's a good way to diversify your portfolio. There's in terms of leasing up a flex space, they're usually rented out in like 2 to 3 months, at least in this market. They're in very high demand. And again, they're easily reconfigurable. Um, I think we've also seen that even in downturns, the vacancy rate on flex space remains pretty steady, much like the overall industrial market, but even maybe more so with the flex kind of niche. Um, we've also seen, especially here, that tenants stay in these spaces for longer periods of time uh, than other asset classes. It's a good it's a good market right now for investors to come in and find these spaces that maybe were locally owned and managed that have tenants in there that are paying well below market rents, um, and you can usually create a lot of value in purchasing the property with below market rents, and then re-tenanting the property at a higher value. With that said, oftentimes when these buildings are acquired, the new landlord will put that new lease in front of the tenants, and they want to stay. It's not very often that they get that new lease as a new landlord and they're like, oh, we're out. Oftentimes these tenants have been there for a long time. They have customers that come there often. They're familiar with it, and their business is there. So there's a lot of stability with the tenants.
Yeah. And back to Zach's point about a diverse tenant base. We have everything from florists to tourist, tourism tenants in our flex space, and it's great. So
This is just a graph here from CoStar, just showing the asking market rent. This is national. This is not just Savannah. This is in green. You're seeing the asking rent per square foot in flex versus just regular logistics or industrial, and then the United States average across the board. So flex is often able to command a higher price because the spaces are smaller, and they'll often include some sort of office aspect. And that's also a challenge on the landlord side occasionally, is figuring out, how much of a price can we command, because we do have this mixture of office and warehouse in a smaller space. Um, the larger the space, typically the less a tenant is going to pay per foot. So, under 20,000 square feet, I think that's kind of John's niche right there. Um, I, I, and then just going back to the tenants, I'm I'm leasing a building right now in Savannah that John does not own. It's a different landlord in New York, but the tenants there, and these are all 10. It's a multi-tenant, 10,000 square feet. They're all national credit. We have Sunbelt Rentals, Dish Network, just really, really good credit tenants, most of them with corporate guarantees, stuff that you're not going to usually find in, say, a small, if it was a 5 to 10,000 square foot office space, that's probably going to be a local group. Where in industrial, you're able to get these corporate guarantees, national tenants in these very, what would consider very small spaces.
Awesome.
I don't think I need to go through all of these, but there's a lot of stuff that goes into a lease. Um, I think some big ones would be OpEx, operating expenses. Typically, in an industrial lease, the tenant is going to be on the hook for all of the operating expenses involved in the property, or what would call their proportional share. So if it's a 10,000 square foot building, and or 100, let's say 100,000 square foot building, and they take up 10,000 square feet, it's going to be 10% of the OpEx. It's usually property taxes, insurance, and then maintenance. And then oftentimes this common area maintenance that you see at the bottom, that would be the shared space that the tenant is using with the other tenants in the building. There'll usually be an additional charge for that the landlord will usually pay for upfront, and then the tenant would be required to reimburse the landlord for maintaining those spaces. And then again, just credit tenant. That's kind of a commercial real estate term, meaning that they have good credit. They're existing, either nationally or regionally. This isn't their only location. They've been in business for a long, long time. And then corporate guarantee, that takes it sort of to another level. Oftentimes, just like real estate investors will purchase a property in a limited liability company for protection, what you'll see is tenants will create their own LLC for that specific lease, which would limit their liability as well. Well, what often happens is that a savvy landlord will ask them to actually get a corporate guarantee, whether it's a publicly traded company or just a larger regional corporation. It's much like when you're an 18-year-old kid trying to get your first apartment lease in the city, and you have to have your parents sign the lease
Co-sign.
for you. Yeah, this is the equivalent for industrial real estate. And usually the tenants will fight back a little bit, but it's very, very common. And the vacancy rates are often so low that they have to
you
get it. So
you can definitely command that, and
yeah,
you end up winning, right? Because you
yeah.
have the space. You ready for the next one?
I think so. Unless there's any other big ones here, John, that you think might be
Yeah,
new to
I mean,
someone.
security deposits, that's pretty standard.
Yeah. I think
Uh,
just on the exit conditions, same thing. Like if you're thinking about like an apartment complex, when these tenants leave, like it's in the lease that
No,
they have to leave the
why
space in the
not?
condition that
It's okay.
they
Let
received it
her
in.
do stuff.
Hot mic. Sorry, Zach.
And
Cool.
so also in commercial, there's a lot of different types of leases. With these flex properties, when John acquires them, there's often these shorter term leases, month to month leases, mom and pop tenants, mom and pop landlords, local groups where, maybe the owner used to use this property for their own business and started letting people rent there, but they weren't these really institutional, savvy investors. So John will find a building like that where tenants are month to month, that sort of thing, and implement his business plan. Not only after he buys the property, but even sometimes while the property's under contract. So he can put this property under contract. If there's any vacancies in there, he can even have leases signed, what we would call having a tenant in tow, meaning that a tenant will sign a lease before John closes on the property. That way, when he closes, there's no lease up risk. And I think, John, you would agree that your business plan often revolves around converting these shorter term leases to long term. With that said, I think there is a market for having these shorter leases, and you can command a much higher price per foot because it's not easy to find. A build to suit, not really John's thing, but it's a common term meaning that a tenant needs a space, but they don't want to build it themselves or own it. Common to just a regular lease, right? But I guess that's a good segue for me to just say that most larger companies, they don't often want the real estate on their books. They don't want to own the real estate. They're not in the business of being real estate investors. They're in the business of, selling drywall or,
They're in the
paving
business
or,
for their business, right?
yeah.
Um,
So
th-
um, oftentimes you'll have a developer will have a tenant come to them and say, hey, we really need this kind of building in this area. Can you find it for us or build it for us? So they'll sign a lease before the building is even constructed, which would allow the landlord to secure financing and permits and all kinds of other cool stuff to get that deal done. A gross lease is a term that just means it's the tenant's going to pay a fixed price per month,
mhm.
and that's going to cover everything. That's I think I would say that that used to be sort of common in the flex space, but as more institutional money is getting funneled into this product type, most of those are changing from gross to what would call a net lease. Um, That's another term that just like flex, a lot of people have different definitions for what net is. When I think of net, it's generally the tenant is on the hook for pretty much every operating expense there is. You'll often hear it called triple net. That would be property taxes, insurance, and then just all common area maintenance. The tenant has to pay all utilities, whether it's electric, water, and then also the maintenance on the property. So eh, John, your leases might be a little different, but I know on a larger industrial lease, the tenant has to maintain the property on their own. If the toilet breaks, the tenant fixes it. If the lights are out, the tenant has to fix it. Um, it's really becomes a sort of hands off experience for the landlord the way these leases are written. Um, and
So,
then
Zach,
go ahead.
typically on like a triple net versus double net versus single net lease, that basically the triple net leases will be a smaller lease rate, but more is on the the tenant versus the double net and single net, you're gonna be able to command the higher rent, but the landlord will have some responsibility and whatnot there. Would you say that's fair to say?
Yeah, yeah. So,
Gotcha.
and then gross lease, hybrid lease, modified gross, they're often interchangeable as well. Or sometimes people refer to as a double net lease, or it can be the same thing as a modified gross. It really depends on what region you're in, or how your landlord's feeling that day. But they're pretty interchangeable. For the most part, with these kinds of properties, flex industrial, multi-tenant industrial, you're going to be looking at full triple net traditional leases.
So lease
Um,
highlights. You want me to take this one?
yeah, this one could be you,
Then,
John.
so on a lot of our industrial flex leases, we we will sign longer term leases with the A and B credit rated tenants, and we will incorporate the automatic increases, which so that way, like I was saying earlier, with the predictability, the stability, we will be able to predict, 3 years out, if their lease is a 5-year lease, they're going to be at X rate, right? And we'll be able to predict, the value of the building, the income, and all that, and so on and so forth, right? So that's why we like, the longer term leases on this industrial flex product. That it's predictable and it's stable. So that's a little bit on lease highlights.
John,
And then
I saw a question from Rakesh. What maintenance is typically covered under CAM? The tenant's usually gonna, again, it's sort of everything. So even like landscaping, paving, anything that's regular wear and tear, for the most part, it's gonna be on the tenant. If it's multi-tenant, they're gonna have to pay for their proportion of the property, which is pretty simple to figure out. On the landlord side, I'll say typically if there's something catastrophic, or structural, that falls on the landlord. So if the roof collapses, it's on the landlord. If the walls start caving in, that's on the landlord. You'll often see sort of heated battles between who has to pay for the capital replacement of the HVAC system. Typically, the tenant has to maintain and service the HVAC system, have sort of contract in place, literally you need to have proof that they're servicing the HVAC. But if the HVAC completely fails and it's not fixable, usually there's almost every lease I end up writing or going back and forth on. It usually takes a couple days to get past the HVAC clause between attorneys. So that's a big one to think
and
about
that
too.
that
But
usually falls on the landlord, right?
yeah,
Yeah.
yes.
We
But I'll say in some other asset classes, so not so much industrial, but you'd be surprised that like a McDonald's or a Wendy's, the triple net single tenant lease, they'll have what they call absolute net leases, which is the landlord is not on the hook for anything, which is pretty interesting. I haven't really seen that in industrial, but I know in those types, it's pretty common.
um so key takeaways on industrial. This is an article that I found, um going through, basically all great points about, the national average on in place rents is 770 a square foot, which is up, just over 7% year over year. And that is kind of more the big box industrial, not necessarily industrial flex specifically, which we learned from Zach earlier that's, in the 14 range, because that is, 10, 20,000 square feet and under. Also, some stats about, how much industrial space has been created, how much industrial space is under construction, what was traded in 2023, which is $52 billion of industrial real estate was traded. That averages about $130 a square foot. Also, Kansas City, which we're under contract to acquire an asset now, has the lowest vacancy rate through the end of December in the country, which is pretty wild. So, great market. Dallas Fort Worth as well, great market. And same with New Jersey, logging the largest sales volume in the Northeast. So great trends in the industry news heading into 2024.
Yeah, John, I think I could say I know that you invest not only in industrial assets, but from getting to know you, I think this is one of your favorite asset classes. And speaking of that, it's a highly fragmented market. Unlike other asset classes that have been highly institutionalized over 100 years. People were syndicating deals in 1910. So this is an industry that hasn't really been institutionalized yet. It's starting to be institutionalized more so on the larger big box spaces. But we're starting to see asset managers, syndicators, operating companies that are raising money to buy assets like this, flex industrial, multi-tenant industrial, smaller single net lease properties like 15,000 square feet, industrial properties, and they're raising money from your regular institutional, type groups like, the California teachers pension, the Texas teachers pension. You'll drive by a warehouse in Savannah, and you don't realize that it's the New York State Police pension that owns that little that little multi-tenant building with your local
wild.
contractors in it. And I think that just speaks to the opportunity because it's really fragmented. There's a lot of arbitrage, right?
And
Like
I think
there's an opportunity here.
it's also overlooked, and a lot of people don't really understand this asset class, and you know
Because
I want
it's not super exciting, right? Like if
well,
you
it's
acquire
definitely
some
not as
beautiful apartment
glamorous.
complex, yeah,
It's not as
so
glamorous as the $50 million 300 unit um high rise tower in you know
yeah.
downtown Chicago or something, or New York, and $50 million is probably a little light there, but yeah, it's but if you to me, I think watching the returns that you see from industrial flex assets is much more sexy than a sexy asset that doesn't put any money in your pocket for 10 years. Just a thought. But I also want to say that I think we're pioneers, and I want to be up there for some of the first people to put together a $5 billion industrial flex portfolio and sell it to the institutions. So
I think that's the game plan.
that is. I guess we're a little over time, but are there any questions that anyone has, if you want to raise your hand or put it in the chat. Let's see. So we have a question from Elise Lynn about flex industrial assets be affected by the economy. Zach, do you want to take that question?
I mean, it will certainly be affected in an economic downturn, just like any asset class. I would say that, as I sort of mentioned earlier, I mean, a lot of these tenants have businesses that are really foundational to everyday life. And then even in a downturn, if you look at COVID, when that hit, there were other, needs that spurred from that downturn that, filled up some of these spaces. You had clinics, you had, labs, things like that that were used in these spaces. So yeah, can the economy affect it negatively? Certainly, just like any other investment. This isn't, absolutely economic downturn proof. Definitely not. I'm not going to sit here and say that, but it's a pretty stable asset. I mean, even for example, in Savannah right now, like there has been a bit of an economic downturn over the past year, but industrial rents have continued to rise, and that's mostly because of the limited supply, and the like not just in Savannah, but cities just not wanting to zone stuff industrial. I'll also say that even like when the economy is really good, it's still very expensive to build this type of product compared to the rents that it commands. So investors are still going to look towards existing assets to acquire. So it's pretty stable.
Agreed. You couldn't have said it more perfectly, Zach.
Can I ask another question?
Sure.
Sure.
So John, you were presenting this, I think was it 12 units the other day?
Yes, in
And you
Kansas
said that there
City.
was, yeah, you said that there was a 66%, it was 66% occupancy rate.
So the reason being there is a tenant just vacated the property. And that's where we're identifying a shortfall of the previous owner in their marketing. And we've identified this gap, and we're pursuing that because we're able to market it to that tenant base that will occupy that asset.
Yeah, I think also sometimes vacancy is a good thing on a property, especially if you've just acquired the property, right? Because if the rents are below market, you're gonna what would refer to as mark to market. So you're gonna if most of the tenants are in there and they're paying $6 a foot, and you bought the property based on that income at say a 6 cap or a 7 cap, you're then going to be able to, list that the vacancy on the market and command a higher price, which most investors, like I'm sure in John's business plan, he's ready for the vacancy. Like he has a plan around that. They have reserves, they have funds in place. On multi-tenant, the good thing is that you still usually do have other tenants occupying the property, where if you're just buying one warehouse, it's if the tenant's gone and it takes you a year to fill up, well, you're at 0% occupancy. And a larger facility, typically in a normal market, like we'll usually tell landlords on, say it's a 50,000 square foot building, we'll market this. It might take 6 months to a year to find a tenant for that building. So you're spending longer periods of time to re-tenant that property. versus these smaller multi-tenant flex spaces. It's typically, less than 6 months before you can, the market will find you a new tenant.
And also real quick, because we got to get on to the other question, but when you get an asset, you're not gonna, to the tenants that have been there for 5 or 6 years or longer, you're not gonna just take their $6 a square foot rent and bring it up to market at $12 a square foot, doubling their rent, because you don't want that reputation as a landlord. However, you do want to increase their rent, and what we'll typically do is we'll go in and increase that rent at much more of a rapid rate than the previous owners. And what we're finding out in a lot of these acquisition cases is that the asset that we're buying, the seller or the previous owner, is not charging market rate rents, and we're able to kind of increase that rent a lot quicker, allowing us to get force the appreciation on these assets. Does that answer your question, Elise?
Well, I'm kind of wondering, why isn't he charging the market rate?
I mean, there's a number of reasons that a landlord wouldn't charge market rate. Mostly it's because these assets are, it's not, and Zach, correct me if I'm wrong, it's not the easiest. If you're not using a leasing agent or a broker, you're not really gonna, know the market rate if you've been owning these assets for a while.
So typically these properties that John is buying, they weren't using a broker to lease the property out. Oftentimes it's an inherited property. It's been in the family for a long time. Maybe they run their business out of the property and lease some of the space out to a friend or a friend of a friend. They're, oftentimes the reason it's not at market rate is they don't know what market rate is, because it's not something that, say, like a stock, you can just go to Google and say, hey, what's the price of the Apple stock today?
Even in multifamily, you can find multifamily rents all over the internet. Industrial is a little more difficult.
So from a brokerage standpoint, the data for leasing comps, but specifically on these more fragmented niches, like for me, I actually mostly, as I kind of mentioned, that I mostly specialize in truck terminals. That's kind of my thing, outdoor storage. Our value prop as a brokerage is that we have good comps, we have comparables, we can tell landlords, hey, this is a lease that we just signed 3 months ago, 4 months ago. This was the tenant, this was the term, this was the annual increases. That's all our information. That's information that we would only share with a client who hires us exclusively. That's kind of the value we bring to guys like John. So it's really just not public knowledge.
Thank you.
Thanks, Zach. Pat, we are going to be sending out the recording of this, and we'll be posting it in the industrial Facebook group. Alan, very true. These assets should cash flow day one. Donna, we own about, I want to say, 6 industrial flex assets, or it's going to be 6 industrial flex assets on a national basis after we close Kansas City. And Pat, we advertise these using brokers who will put them on, LoopNet, Crexy, and then I've had incredible success on Facebook Marketplace, believe it or not. So, There's our contact information. I'm gonna stop the recording. Let's see where. Stop the